I'm looking at a risk picture for 100 shares of Apple stock. Now, Apple stock, because it's selling at $267 right now, it would cost $26,700 to buy 100 shares of Apple stock. But let's say you have the money to do that and you wanted to know what your risk was. And even though Apple has been on a tear most of the year going higher, you heard it was going to 300 and you believed it, and you want to see if you can participate in that move up toward 300 over the next couple of months. What the risk picture does is it shows you what the value of your position would be if price were to move up in the direction you want, or if the price were to move down. You could see how much your risk on the trade is and how much you stand to lose if you're wrong on the trade and Apple actually moves down. If I bring my mouse over and just hover it over the picture and move up near the 270 mark here, you can see that I would be up $280 if the price got to 270. Let's say I bought it today at 266.95 and then price went up to 270, I'd be up a couple $100. And if price could work its way up to 280, I'd be up $1,300. And if it got up to 290, $2,300. And if it did reach the $300 level, which is what my expectation is, it would be worth over $3,000 more. So I'd be risking essentially $26,700 to try and make that $3,000. That's assuming that Apple stock could possibly go to zero. And while it's not likely that that could happen, there have been enough companies that have gone to zero, even some big companies like WorldCom, Enron, Lehman Brothers, to where you have to at least understand that the possibility exists. Now let's look at what the downside would look like. What if price were to move down to 260? I'd be down $700. If it moved down to 250, I'd be down $1,700. What if it came out here, the edge of this shaded area? I'd be at almost $2,500 down. While I mention this shaded area, here's what this actually means on this broker platform, Thinkorswim. If I set this date up here to the date that I want, and in this case I have it set to January 18th, 2020, which is the January options expiration, what it does is it shades the area of the expected move, or the move that would be more than likely to happen. 68% chance that Apple will finish in between this range from 242 up to about 292. And if I set the date to a different date, it would shade a different amount of the price graph. So let's say I went to December options expiration. Then notice how it brought in the shaded area, because over the time frame to December expiration, the 68% chance of movement is much less than if I brought it out to January. And if I wanted to see how much it would move to February, and this doesn't mean it's going to happen, this is just based on the current prices of the options that are being sold, the expectation of that move based on the price leads mathematically them to believe that the price could move this amount, and that there's a 68% chance that it would stay in that range, which is the shaded area. So we use this as a guide to see where price might go, and it gives us a way to manage our risk. If price were to go to that point or out as far as that point, we could decide what our risk is and decide if there's something we would want to do to make the trade have less risk in certain areas. So I'm going to move this back to the January expiration for now. Before I show you how to protect your stock position, we're going to spend some time looking at a few charts to see why protecting your position could be a good idea.